Welcome to the Times of Industry Show. I have a mega interview for everyone today. It's a historic day to do this interview as the QE Infinity was announced, $4 trillion. I will let the guest talk to us about that because he's done a lot of work in the field of history of financial collapses, disasters, economy, a lot about the Austrian School of Economics. Harley Schlanger is with us today. We're doing this interview on the 24th of March as the markets get ready to close here. And we've had just an enormous day, and I am very excited to have Harley back on the show. Thank you very much for joining us, Harley.
Well, I'm always happy to join you, Leo.
Look, I've read your latest piece, brilliant work, and I wanna ask you about the unprecedented Fed actions. First of all, can you please summarize them so everyone would know what the Fed has been up to? And secondly, could you tell me if you think this is good or bad? Was this justified use of their arsenal tool, or are we opening ourselves up for the mother of all disasters 10 to 20 years down the road, becoming junkies basically to nationalizing losses?
Well, I don't know if it'll even take 10 to 20 years at the rate it's going. You have to overlook the volatility of the last couple of weeks to get a real picture of what we're facing. And I'll go a little bit later into the more historic depth on it. But this current crisis was first picked up in mid-September of last year, 2019, when JP Morgan Chase and a bank in Japan that did a lot of the overnight lending, the so-called repurchasing or the repo market, pulled out of it. And people were surprised because this is 24-hour loans. It's to get various clients through the night with bookkeeping and accounting. And the interest rates were going up. So why would a relatively lucrative activity be dumped by JP Morgan Chase? And what became clear is that JP Morgan Chase realized that they were taking financial paper in return for their cash of dubious value. And they were fearing that one night they might come back to return the paper and expect to get the money plus interest, and there'd be nothing there, which could trigger a chain reaction collapse. So they went to the Fed. This was on September 17th. And they said to the Fed, you've got to take this over. So the Fed did. So starting on the 18th, actually I think it was 17th was a weekend, the beginning of the next week, they had a demand for $30 billion overnight money. And the Fed thought, they were saying this will be about a 1 week, 2 week process. A month later, they were now being asked for $50 billion overnight, and they had to come up with a second agreement, which was a 14-day repo loan. And then after that, by December, they were up to the 70 billion or higher a night. A couple times it touched 100 billion. Now, what's happening is that these are loans that are going to hedge funds. They're loans going to some corporations, including zombie corporations, which are called zombies because they don't make enough profit in a year to cover the interest on the debt. So the first question is, why would you continue loaning money to companies in this shape? Then you realize that about 40% of the corporate bonds that have been offered since the middle of last year are at BBB rating or lower, just above junk bond. And so you have this nightly fix that by the middle of January was well over 100 billion a night. And in the last weeks, the Fed finally said, we've got to provide security for people, let them know that whatever they need, they can have. So they announced 700 billion in quantitative easing, 500 billion of which would be treasury purchases and 200 billion mortgage-backed securities, 1.5 trillion in repo, the repo program. And then the next day they said, well, we're going to do another trillion with repo. So that's 2.5 trillion. Now what's thought, and I can't confirm this, but that they're not just providing this money for hedge funds and money market funds, but this money is also going to banks, including possibly Deutsche Bank or BNP Paribas. So you have a situation where this seems to be out of control. Now, on top of that, they started buying commercial paper. that is corporate debt. And they're not allowed to do that by their charter. They're going to have to go to Congress to get an exemption from their charter. Then they're letting the dealers they're loaning money to use stock as collateral. This is also not allowed by the Fed charter. And finally, and this is the one that caused people to start thinking about Deutsche Bank, is they were opening unlimited dollar swap lines to other central banks for essentially allowing international bailout lending. So this is what Mario Draghi, the head of the European Central Bank, called the big bazookas. In other words, he said, you can't solve this problem with a little bit here, a little bit there. You have to bring out the big guns. But what we've seen is as they brought these things online, the volatility continued. You know, yesterday was another example of that. Today, I think it's another volatile day on Wall Street. I think it's trending up quite a bit today. But the problem is not the stock market. It's the separation of monetary and financial system from the physical economy. And ultimately, that's the danger. You can print money under modern monetary theory till you're blue in the face without having a problem, which I don't believe. I think eventually you end up with hyperinflation. But the cause of the hyperinflation is it's all monetary. There's nothing physical. And the Western countries have outsourced so much of their manufacturing, which we, by the way, now see because of the coronavirus, the supply chain question, that there's not enough production to back it up. So in a nutshell, that's the current problem that will not be solved by bailouts.
That's incredible. And you know, what's interesting about this is that Neil Kashkari goes on, and he's the president of the Indianapolis Fed. He goes on 60 Minutes, and to me, it looked like the interviewer was fed those questions freehand, so he can ask the right questions, and Neil can answer a scripted reply. And basically, he said, "Look, we have an infinite amount of cash, and we will do anything to help the economy. We will act much more aggressively, quicker than 2000." So, what a reckless thing to say for a central banker. They're basically telling you, "Hey, take risk, we're behind you," and therefore, gold has exploded in the last 2 days, going from under 1,500. Today, it's over 1,640. The LBMA just announced that it warns of liquidity shortages. This is big. Now, silver is bouncing back off 11-year lows, and the ratio is still like 115 to 1. So who will lead in the coming year or months ahead in terms of the precious metals, the gold, silver, the mining shares, or do you think the general markets will actually outperform the metals?
Well, I think that it's impossible to know based on where things are right now, except for one factor, which is that Russia and China are big purchasers of gold. And they're looking at where to go in the post-petrodollar era. And I think this is something that people have known is coming. The euro is a catastrophe. And the problem with the European Union was just exposed by the rejection of the European Union initially to allow Italy to float bonds to deal with the coronavirus crisis. And when Italy asked for permission to do 7.5 billion, the EU said no. And then Italy said, well, screw you, we're doing 25 billion. And so they had to suspend the Maastricht formula and so on. So the EU is in big trouble. And despite what President Trump says, the dollar is in trouble. And look, the dollar is the haven that people look to. But if you pump this amount of liquidity into a system to try to sustain unsustainable debt on the books of banks and the shadow banking system, at a certain point, the dollar is going to collapse. Now, there are two other things, Leo, I just called to your attention. One is money market funds are hemorrhaging. They need quick infusions. One of the Dreyfus funds, the Bank of New York Mellon, had to come up with $2.1 billion to bail it out. One of the JP Morgan, or was it JP Morgan? No, one of the Goldman Sachs Square something money fund, which is an $18 billion fund, is now close to the 30% level of liquidity, which is considered the danger level for a money market fund. So you have that problem. But the other thing is this question of debt. The corporations are taking on huge volumes of debt, and much of it at below investment grade levels. And they're doing it because they're not producing. They use the Trump tax cuts for stock buybacks. And now they're asking for a bailout from the federal government. And finally, someone had the guts to say, why should we bail out a company that just had billions of dollars repatriated and used it to buy stock to build up a stock bubble when the company's not producing? So we're reaching a point of no return. I think the tendency for individual investors will be to look for gold or silver or platinum or maybe some other metal. But that, in the long run, my point is that if you don't have a sound exchange system, and the floating exchange system has been a catastrophe, increasing catastrophe, if you don't move back to some form of fixed exchange or something backing up the money that's being printed, you're going to end up with a hyperinflationary collapse or a deflationary collapse, one or the other. So that's my prognostication.
Okay, so having said that, let's talk about this new term that we've all been introduced to, or most people have been introduced to in the last few months, and that's the repo, the Repurchase Agreement operation. Can you go into this in depth and describe it to people? Because many do not understand if it expands the Fed's balance sheet or if it does basically nothing to the balance sheet, and what is its purpose?
Well, originally it was for the balance sheet, that if you had a company that had a quarterly report coming due and it had some problems with a client or a shortage somewhere, they could go and borrow money to tide them over through the accounting period. And they were able to do this, they figured it out on these 24-hour loans. So if you had to file your papers tomorrow morning and you were short, you could go and borrow money quickly, put some kind of financial instrument down as collateral, and the next day you come up with money from somewhere else to pay it off. Now, the problem is the banks that were doing this realized that some of these companies or some of these funds didn't have money coming in. And so they were borrowing one day from the repo markets, and the next day they were going somewhere else, the commercial paper markets, wherever they could find cash. And some of the companies that were doing this actually had a lot of liquidity in the banks, but they didn't want to draw on that. Now we're seeing them draw on that. Boeing and others are drawing out huge volume of money from their credit lines because they're afraid the money won't be there in 6 months or a year. So the problem is not liquidity, although the short-term reason for the repo market is liquidity. The problem is solvency. And many of these companies should be put through bankruptcy reorganization because they're not making the money to cover their expenses, including in some cases the so-called zombie corporations that don't make enough profit in a year to cover the interest on their debt. But the problem is this debt is being carried on the books of banks, hedge funds, other kinds of funds. And if it's somewhat like Lehman Brothers in 2008, September 2008, when suddenly Paulson said, we're shutting you down, we're cutting you off. And the CEO of Lehman said, so now I'm the schmuck? Meaning all the rest of you at this table have the same problem we do with leverage and lack of real assets. Why are we the ones being shut down? Well, right after Lehman got shut down, what happened? They had to bail out all the rest of them. So if you think about the 2008 as a turning point, we should have gone at that point back to the previous model of Glass-Steagall banking separation, that you don't allow banks, commercial banks, to engage in speculation. But the reason they do is they weren't making profit in their normal ways. So they were looking for more risky investments to justify what they were doing. And so they started loading up on bad commercial paper, bad mortgage, the so-called mortgage-backed securities and so on. So the repo operation was just one form of a liquidity operation that was originally meant as a simple end of a quarter or end of a term balancing operation, an accounting operation. And as such, it wasn't dangerous. it became dangerous when they found out that the companies that were borrowing on the repo markets were using questionable assets as collateral. And that's when JP Morgan Chase pulled out.
Okay, so now let's talk about the hottest topic out there with this coronavirus crisis, and that's helicopter money.
Yeah.
Mnuchin and the Fed, they collaborated. They're going to do $4 trillion in small business loans. They're going to do forgivable loans. They're going to inject $3,000 for each American family of four. Is this the right idea for the times? I mean, what would you do differently? Basically, we have a problem that the government has said to people, close your businesses. So there is a problem that the government created. Obviously, it didn't create a virus. It's obviously balancing between loss of life and economic activity. It's a huge problem. I'm not discounting anything. It's a nightmare. But what is this the right solution for the times? Would you do $3,000 loans? What would you do differently? Is this the right way to go?
No, it's not the right way to go because there are two aspects to it. First of all, there's the health emergency. And for this, the Western governments, because of 40 years of austerity and privatization of healthcare, created a situation where there's no redundancy. We don't have the capability to deal with the pandemic. And so you have shortages of equipment, shortages of personal protective equipment and respirators and testing kits and things of that sort. So you do need a certain amount of money to enable that to occur. That's necessary. That's what governments are there for. When there are emergencies, you take care of people's lives. Now, that's not the $4.5 trillion that's the stimulus plus quantitative easing plus helicopter money. There's a certain amount of that that's included in there. But the bigger portion of this, when they say, look at the Financial Times, for example, today had an article, coronavirus, the moment for helicopter money. And they couched it in terms that you need to have deficits. You need financial deficits in order to fight the crisis. Okay, that's true. However, they then went on to say that it's not just deficit spending to aid people, but to save the system. And they quote the St. Louis Federal Reserve President Bullard, who said, people should not argue about bailouts or moral hazard because we do have to bail out these interests. So this is where I would do it differently. The emergency money, absolutely, make it available. If it's a deficit, so what? You can cover that if you get the economy going again. However, that's the bigger problem. You're not going to get the economy going again if all you're doing is bailing out deeply indebted corporations that don't have a model that can show how they can get out of it. All you're doing is, it's like paying a mortgage with a credit card. You may cover the monthly cost, but you're adding to the future cost. And we've seen an explosion of corporate debt, consumer debt. If you have a consumer economy, and people have used their credit cards to the limit. There's a growing number of delinquencies with credit cards. You have the student loan problem, auto loan problem, and so on. More debt isn't the solution. You need to have an investment policy in the physical economy. Now, this is why what we've been writing about for quite a while is a Hamiltonian credit system. To go back to what Alexander Hamilton did to extricate the United States from the problem of the Revolutionary War debt. And that was that you have a national bank, not a private central bank like the Fed, but a national bank, which generates credit through a protected commercial banking system that will go to entrepreneurs, to industries, to local bonds for infrastructure and so on. In other words, physical production, physical activity where you're doing something that produces real wealth. And a portion of this going into scientific research and development so you create new technologies for productivity increase. That's what you have to do for long-term stability. And by long-term, I'm talking about 2 to 3 years. You can't get out of this thing quickly. But if your policy is, well, we have to save the system now, we'll worry about these other things later, you're just increasing the indebtedness that will either lead to a collapse of the debt, in other words, a an unofficial moratorium in a sense, or you have a reorganization which is organized, which is coordinated so that you don't have a total collapse of production. So again, just to summarize, take care of the emergency, but the financial emergency is a different question. And that's why Glass-Steagall, banking separation, protect the commercial banks, and use them as the instruments through which government credit is allocated to rebuild our industrial base and manufacturing base.
Harley, where can people check out your work?
Well, I write articles virtually every week now, and they appear on my blog, which is on the larouchepack.com site. But to get there, the best way to do it is send an email to me at my personal email address, harleysch@gmail.com. And I'll send out a link. And I do this partly because I like to hear from people. I like to hear what people think about what I'm saying and engage in an ongoing dialogue. And I find it very useful because there are a lot of people out there with good ideas who don't know who to bounce them off. There are also a lot of people who are very anxiety ridden and are just looking for someone to talk to. So if people want to be in communication with me, I'll send you my blog page if that's all you want, but feel free to write to me at harleysch@gmail.com.
That's very generous of you, harleysch@gmail.com, and hopefully people will definitely take you up on that offer. And let's definitely circle back in a few months, sir.
Well, it'll be interesting to see what happens over the next couple of months. So sure, I'd be happy to.
Okay. Well, thank you very much, Harley.